Let's talk a little bit about how a bank works. Banks are no different than any other business. They exist to make money for their stockholders. They provide a number of money-related services, such as savings accounts and loans. Customers give banks their money to keep it safe, for example, a savings account, and assure you that you can take your money out whenever you need it. Banks use that money that's entrusted with them. They believe that not everyone will want all their money at the same time. So they take a percentage of the money that they are keeping safe and use it to make more money. They use that money to make loans to other customers, businesses, and even the government, and receive more money in the form of interest or invest the money in other investments like the stock market and mutual funds. In return for allowing banks to use your money, they pay you a small percentage back in interest. Now let's take a look at some of the different types of financial institutions. Banks or financial institutions are broken into two categories: depository and non-depository. Depository banks use the money received from customers' deposits to create more capital, much like I explained before. One of the programs that came about due to the Great Depression is the creation of the FDIC and NCUA. These programs ensure that the money deposited into your account up to $250,000. Non-depository institutions rely on interest from loans and other investments to make their money. Customers give them their money to use with the hope that they will receive more money. Since investing is not a sure thing, money given to non-depository institutions is not insured. Examples of non-depository institutions include mutual fund companies, which sell shares of corporations, brokerage firms that manage the purchase of stocks and bonds and other investments, and mortgage companies, which specialize in loaning out money for real estate and homes. Depository institutions work a little bit differently. They still offer loans, but also use money that is put into savings account. In exchange, each deposit account receives a small amount of interest. Commercial banks, or just banks, are also known as full-service banks. They are a for-profit business like I talked about earlier. Savings accounts and banks are insured by the FDIC up to $250,000. All banks either have a national or state charter, which is a license to operate. National charters allow banks to open branches anywhere in the United States, while state charters limit banks to open branches only in that state. Credit unions are nonprofit financial organizations. Since they operate as a nonprofit, they do not pay federal income tax. Because of this, they can offer higher APYs and lower APRs. Credit unions are owned by their members. Some may have broad restrictions on who can be a member, like live in a certain area or work at a certain employer. Credit unions operate under either a national or state charter, and deposits are insured by the NCUA for up to $250,000. Savings and loans associations offer most of the same services as a bank or credit union. However, savings and loans specialize in mortgages. So an individual may be able to get a better rate there. There are two types of savings and loans associations. The first, a mutual savings and loan association, operates much like a credit union in that it operates for the benefit of its members, whereas a stock savings and loan association operates like a bank that is owned by the stockholders.